Welcome to today's webinar. My name is Fawad Razaqzada, market analyst with Think Markets. And today's webinar, I'm presenting with the help of my colleague, Victor.
Hello.
Hello, Victor. How are you doing, mate?
Yeah, very good.
Yeah.
Very keen to start this properly.
Yeah, exactly. Sorry, we had some technical issues earlier. I couldn't share my screen, but now I can. So let's crack on. Before we proceed, let me read the first paragraph, the risk warning for you guys. These webinars are for general information only and are not intended to provide trading or investment advice or personal recommendations. Any information related to past performance of an investment does not necessarily guarantee future performance. Think Markets shall not be responsible for any losses you incur, either directly or indirectly, arising from any investments based on any information in this webinar. Please remember that spread betting and trading CFDs carry significant risks and may not be suitable for all investors. Okay, move on. Quick reminder, this webinar is taking place every Tuesday at 11:30 London time. So for those of you who are watching this on YouTube, please make sure to join us next time, because you will have the opportunity to ask us any questions on any markets that are tradable with Think Markets, okay? So it's mostly on technical analysis of live charts. We will share the live charts in a minute or so. And we do briefly touch on fundamentals as well. So what's driving the markets? Well, this chart tells us exactly what's happening. Okay, so as you can see at the bottom of the screen, the market capitalization for technology stocks, as well as some consumer discretionary, have been falling in recent weeks. Meanwhile, the market cap for financials, energies, and so on have been rising. So people have been rotating into stocks that are more sensitive to economic growth, yeah, and away from so-called growth stocks, which are like basically technology names. And that's why the Nasdaq has really struggled in the last few weeks, while the S&P, the Dow in Europe, the FTSE, the DAX, these indices have all rallied. But the Nasdaq, which was the star performer in 2020, has really struggled because people are rotating into value stocks now. Okay, and as a result of that, you can see that the world index has fallen a little bit, but overall, I think sentiment remains positive, risk on, and as I mentioned, value stocks have been doing very well. Crude oil prices have been rallying on hopes that demand will recover. So it's all based on optimism surrounding the vaccines. That's what's keeping the bulls happy for now. But it's also creating a headache for central banks because inflation expectations are on the rise. As you can see, as you will see in a minute or so, yields have been rising rapidly in recent weeks. And this is a key development for the markets because investors are basically expecting central banks to stop buying bonds or reduce buying bonds, and in the medium term to increase interest rates to tame inflation. Okay, so that is something that could come back and hurt, all major equity market sectors if interest rates do begin to rise, and QE is going to be tapered, except the banks, of course, because rising interest rates are good for the banks. So it's something to watch if yields continue to rise. And in terms of this week, we do have a couple of really important macro events. Consumer price index from the US is going to be very important, as it will give us a strong idea how price levels are shaping up in the US and the world's largest economy. We do have a couple of central bank meetings. The Bank of Canada meets on Wednesday, but more to the point is the European Central Bank policy meeting on Thursday that will likely be the key focus for the markets. Yields have been rising not just in the US, but in Eurozone as well. And that's something that the ECB President Christine Lagarde will have to address. Jobless claims will be released as usual on Thursday. But in terms of market moving data, I think the Canadian employment report is really important to watch on Friday, as it could move the Canadian dollar sharply. So Victor, let me bring you in here before we go to the live charts. What event do you think this week is going to be the most important one for the markets to watch?
Well, I think that inflation watch is the theme of the week. CPI from the US particularly, but yeah, I wouldn't ignore the data from China either, because well, basically the world has been exporting its inflation to China over recent years, decades even, and we might start to see the reverse happening sometime soon if Chinese prices start rising and their export prices start rising. While currency debasement in developed economies due to the high levels of public debt ensues, we could see a dramatic shift. Something that central banks are not even foreseeing yet. So those inflation numbers are the ones to watch this week, in my opinion.
Absolutely, yeah. It's going to be very important to watch, and it could impact the bond market, and that's what the focus is on right now, with yields rising, as you can see, for the last several months, with the pace increasing really in the last few weeks, because people are getting. This is what you need to watch really closely, because if yields in the US were to rebound and today they're a little bit lower, but if the trend resumes and they push upwards and onwards, this could put strong pressure on the US dollar, and the dollar has already been making a nice comeback against haven currencies like the Japanese yen and the Swiss franc, recently even against the euro, but so far its gains have been limited against commodity dollars. But if yields continue to rise, then even commodity dollars could come under pressure against the US dollar. So it's something to definitely watch out for. And in terms of the ECB meeting as well happening, so keep a close eye on the German bond yields as well. Yields in Eurozone have been rising, although not as rapidly as in the US, hence why the euro dollar has fallen below 120 handle. But you have to think about what the outlook for monetary policy is in the Eurozone. And, given how the vaccine rollouts are going and the number of virus cases are falling, deaths are falling, you'd have to think that the next policy move by the European Central Bank will be to tighten monetary policy rather than loosen it. So on that basis, the ECB will have a very difficult job keeping investors happy that bond buying will be here for a while yet. So I think there's a possibility that we will see German yields rise sharply this week as a result of the or in the aftermath of the ECB's policy decision. So that could impact European stocks. It could lift the euro possibly against some of the weaker currencies. And one of those currencies is the Swiss franc. And I know I've got the dollar index here. Let me talk about the Swiss franc, okay? Because it's one of those currency pairs that's catching my attention at the moment. I'll come back to the dollar index and the majors. But the Euro Swiss, has been rising sharply, and I think it's going to accelerate its gains because the ongoing risk-on rally is hurting the safe haven appeal of the franc. And I think the European Central Bank meeting this week is going to lift the euro as well. So I think the Euro Swiss is likely to rise further in this week and in the weeks to come. This month, this is a weekly chart rather. This weekly chart of the Euro Swiss shows price has been holding the long-term bullish trend line. Recently, it's broken out of above the bearish trend and out from this consolidation phase, taking out strong resistance in this area here. and it hasn't looked back after that breakout a couple of weeks ago. So looking at the daily, I think the trend is quite bullish. You will get to see a small pullback here and there, but ultimately the trend is bullish. There's macro drivers behind this. So I think what might happen here is we might consolidate today and tomorrow, and then on the ECB day on Thursday, it's likely to, in my view, to take off once again. So watch this currency pair very closely. Key support comes in around this shaded region. I don't know if it will get down to that area, around the 110 area. I think 110.50 is likely to be a good support zone to watch for a potential bounce. But I'm not sure if we'll get deeper than that. But we'll see. In any case, the trend is bullish until the charts tell you otherwise. Okay, so I just want to highlight that very quickly before touching on the majors. So going back to the majors, the dollar, as I mentioned, is a little bit weak because bond yields have fallen. This is the 10-year, as I showed you earlier. It's fallen today.
It's starting today on the back foot, and we have seen quite a decent rally over the past several days, though.
Yeah,
and a couple of weeks.
So
this pullback is not unexpected. For now, it's not something to really worry about. I would say that if we move on to the euro-dollar chart and look at the key levels, I would say that the main level to watch would be the 109.50-70 area, if I'm not mistaken.
So somewhere around here.
Yeah, 50. Yeah. So this has been a previous low, an important level that also served as a breakout to the upside.
Right here,
just between 109.50 and 120. So I would expect some sellers to materialize once we reach those levels, if not lower.
So basically, Victor is talking about this shaded region. For those of you that didn't see me pushing this red level up, this region right here, which was previously resistance, and a breakout point, which turned into support momentarily before price broke down to the downside. So what are your downside targets then if the selling resumes from the shaded region, if price were to get there?
Well, if the selling resumes, I expect that the next point of support would be the 200-day moving average.
Okay.
Which we haven't touched yet. And
it comes in at 118.16 according to this price feed, by the way.
Yeah, something like that. And next, we're probably going to test the 116 level.
Oh wow! So you're quite bearish on this. 116 being these lows, right?
Yeah, well, for now, I don't see any reason. Well, obviously, there is a big if, which is the inflation data and the Federal
ECB.
Reserve's reaction to it next week. But I don't think that the ECB is going to be overtly hawkish at this point in time. Because the recovery in the Eurozone is still quite fragile. We still might see a recession, meaning that the first quarter of this year could still be negative. So I don't expect the ECB to actually do anything or say anything to encourage a rally in the euro, a sustained rally in the euro, that is.
Okay, interesting. What about commodity dollars? I mean, we've seen the Aussie dollar come back down a little bit over the last few days, but today it's kind of bounced really strongly along with risk assets, with the stock indices. I mean, if you look at the weekly chart, a couple of weeks ago, we printed this large or relatively large bearish engulfing candle. Yeah. But there's been little downside so far on the weekly time frame.
Yeah. So far so good for Aussie bulls that keep on holding the reins, but I just don't see this move being sustainable, because inflation figures in the US are really, I expect them to be just starting to rise. And coming from low base effects related to oil prices last year. The figures for March and for April especially are going to be very, very strong on the inflation front. Should be.
So you think it's gonna go down, the Aussie dollar, because of
I think that
rising...
this is another mirror of the move in yields, which we started with. There is every good move has a correction, so I would expect the Aussie to pause around 77.50 if it even reaches there.
Okay, so just above this red line in this shaded region.
Yeah.
Interesting. We've got a couple of people in the room. I encourage you guys to ask us questions if you have any.
Submit your questions.
Yeah, submit your questions. We'll be happy to talk about any markets that you guys are interested in. Meanwhile, let's have a look at a couple of more currency pairs, and we'll move on to the indices. Euro pound is important because of the ECB meeting this week. The Euro pound has been trending lower. I think it's gonna go further lower because I think I'm more bullish on the pound than I am on the euro. The reason being is that the UK has started to come out of lockdown. Schools have restarted, which is great news because my kids are not. One of my kids are not home today.
Congrats.
Yeah, the other one is still here. Soon, restaurants and pubs and so on will start opening, and hopefully that will kickstart the UK economy, meaning the pound could be about to resume higher. It has stalled a little bit against the dollar, but against other currencies, it's still looking strong, especially against the euro and the Swiss franc and the like. So the euro pound, I think, is possibly headed down to 85, which is the next key level of support, below the most recent lows. And that's the kind of area I'm expecting it to go. But over time, it could go a lot lower. But in terms of resistance, if you're looking to trade this pair, I think 86 is a key level here, which is the point of origin of the latest move down that happened yesterday, and the head of this doji candle. That's the first key level of resistance. Beyond that, there's not significant resistance until 87 handle, which was price support and resistance. And beyond that, if it gets above 87, then you'd have to think twice about trading this market on the short side until price shows a key reversal signal at a higher level. Talking about the pound, the pound against the dollar, I had marked the 140 handle from ages ago, and I did talk extensively about the importance of this level in my previous webinars. The reason I was talking about 140 is because that level was the, if you look at the monthly time frame, 140 was the sort of area price was trading around before the 2016 referendum. So it's a psychologically important point in the market, as well as a psychologically important level, right? And previously, the pound had found resistance there in 2018 and in 2017. So it's kind of mid that target. It overshot it a little bit, and then it went back below. So in terms of short term, that level remains key. For as long as we hold below it, I would say that the pound would remain in consolidation to slightly bearish buys, short-term bearish buys. Longer term, the trend is still bullish, right? Make no mistake about it. But short term, we've seen price breaking down a little bit. So what you need to see is for price to make a higher high and go back above this recent high that was hit at 140. Once it goes above that level, I think that would signal the resumption of the long-term bullish trend. Were you saying something?
If there is a currency against which you want to short the dollar, the pound is probably it.
Exactly.
Because since the start of the year, well, even earlier, it has been on a pretty trend-driven move, and it's unlikely that this is going to stop anytime soon, just because Brexit uncertainty is out of the way, despite some hiccups over recent days, where the EU is already threatening to take the UK to court over some disputes at the Irish border. But let's see how that goes.
So I agree with Victor there. Now, if you're not sure about the direction of the dollar, it's if you are bullish like us on the pound, then it's best to look at the pound cross. So right now, pound yen is trending really strongly because the yen, being a safe haven currency, is falling, and the pound is continuing to rise because of the macro factors we've just mentioned. From a technical point of view, yes, it does look a little bit overbought at these levels, but you can't argue against this rising trend. It's taken out numerous resistance levels already, so the trend is only getting stronger. So if you're a short-term trader, I would recommend looking into this pound cross and look to buy the dips at support. Obviously, not forgetting your risk management. But for as long as price is making higher highs and higher lows, I think the easier trade is to look for the long to look for long setups rather than short setups on this pair. And if and when the trend turns, then you can forget about it and look at something else that makes more sense. But right now, this currency pair makes the most sense to me from a bullish point of view on the pound, which is still pointing higher. So recently, well, today it's taken out the previous high that was hit on 5th of February at 150.44. Touched this level a few times, and today it looks like it's broken out and above it. So what I'm expecting next is for price to return back to this level. If it does, then I think it's gonna bounce and head higher. So the key support area now on this time frame is between 150.44 to 150, the psychologically important level. So this shaded region is where I'm expecting the pound to potentially bounce from. Okay. Now, at what point will I drop my bullish bias? I think if it goes below this low here, so let me just move this up. Sorry, what am I doing? This level here. Yeah, that's my invalidation level now, the line in the sand, the last low prior to price making a higher high. So if it goes below this low at 147, then at that point, I would drop my short-term bullish view on this market. Obviously, we can talk about other pound crosses, but you get the picture. The pound is looking strong across the board, especially against haven currencies like the yen and the Swiss franc, and to some degree, the euro as well. Now, let's look at some indices, okay? First of all, the NASDAQ has been looking the weakest, as we mentioned at the start of the webinar, because of the ongoing rotation into value stocks and away from growth stocks. The Nasdaq has broken its trend line. It's made a few, made a lower low here, and it's still holding below that breakdown level, the shaded region here. If it starts to go above that area, then perhaps this would start to look bullish once again. But for now, it is the least bullish of the major indices as things stand. Indeed, if you look at the DAX recently looked like it was going to falter, and it did print a bearish looking candle here a few days ago, an inverted hammer,
and then it broke out.
Yeah, and then look at the downside. It wasn't like after that was formed, price or the index rather should have fallen really sharply. It didn't. Over the next couple of days, it just held, around the that inverted hammer candle, and that was a big clue that would should have told you that it's not going to break down like the Nasdaq is. And if that wasn't enough, yesterday it done this, broke really sharply above that area. So the DAX is looking quite bullish, and so I would expect the future dips to be supported back into this area. Yeah, and for as long as it maintains a series of higher highs and higher lows, the path of least resistance would be to the upside. However, if it breaks below the most recent low that was created right here, then at that point, I would drop my bullish view on this market. Obviously, with
at that
rising,
point, we would be observing a fake breakout to the upside. Exactly. That is basically reversing.
Which is not entirely impossible if you can think about it. We've got the ECB meeting this week. That could be the trigger. Who knows? Yields are rising. Growth in the Eurozone is not great. It's really weak, if anything. There are bearish reasons, but we are not here to fight the trend, right? We want to go with the trend, and right now the trend is bullish, and we will change our views if and when price tells us it's time to do so. And right now, that's not the time. Likewise, with the FTSE 100, it is beginning to look really strong again. The FTSE has been consolidating its recent gains. The FTSE came back to life really in October, end of October, start of November, and it rallied all the way until the start of this year. Since then, it has been really going sideways inside this triangle pattern. But as you can see, today it's poking above the triangle, which is a continuation pattern. So with this in mind, I think the FTSE is one to watch on the upside. Okay. Let's now talk about.
I couldn't agree more. I think that it has also been helped by the declining value of the British pound.
Exactly.
Against the dollar, that is. So you should be cautious if you see the pound breaking out and starting to threaten that 140 level again.
Yeah.
Perhaps the FTSE is going to kind of get tempered.
The pound and the FTSE have a strong negative correlation, or it does from time to time anyway, and that's because obviously if the pound strengthens, it means that it's got so many implications on the FTSE. First of all, a rising pound is bad news for exports. Okay, because it makes UK goods and services more dearer for foreign investors or foreign purchasers. A rising pound also hurts earnings made abroad, and there's lots of multinational companies in the FTSE 100 that earn their profits abroad in the US, Eurozone. So when the pound is rising against those currencies, and when these companies then convert their earnings back to pounds, then they appear less than they do in dollar and euro terms. So a rising pound is not good for the FTSE, in other words. I can't see any questions, Victor. Can you?
No, guys, don't be shy. Shout out with your questions.
Yeah. Gold here, guys, is obviously it's bounced back because of yields going the opposite direction. But it remains inside this bearish channel, and it's bounced from the
It confirmed our channel that we drew just Friday, no?
Yeah. On the NFP day, wasn't it? We drew this channel.
Yeah.
Yeah.
It confirmed it yesterday. It basically bounced off from the lows, and
yeah.
Let's see how it goes.
Yeah. So the first area of trouble is being tested right now today. This shaded region. If it starts to break above this area, then it's likely that we may see a deeper retracement inside this bearish channel, which wouldn't be a major surprise really, because a lot of people are still bullish on gold, and it's an undoubted, it's very likely that people have bought in this dip, and that's how the markets work. They don't always go down or up in a straight line. You'll get rallies here and there. Even if you look at this region here, you had numerous bearish attempts that failed until price reached the top of the channel. Then it broke down. So we could see a nice recovery in gold back in the middle of the channel, and then we could see the bearish trend resume. And as I mentioned on Friday, I would remain bearish on gold until the charts tell me that it's time to turn bullish again. And specifically, the level I'm looking at is 1816, the most recent high that was created prior to the move down. If and when we go above that level, at that point, I would turn bullish, because then price will have also reclaimed the 1800 level, which is a key level on the historical charts if you look at your weeklies and your monthly charts. So 1816 is the level I'm looking at right now in terms of a reversal, and we are miles away from that level now, more than $100 away from it. So it's something that I've left it there for now, but obviously I will bring that level down and down as and when price creates further structures at lower levels to tell me when to turn bullish, basically. There's also another trend line if you draw from this high, connecting these highs here. See that? So if we do get a rally in gold, the most likely scenario would be for price to then turn lower from here. Something like that. Right. In terms of crude oil, Brent has been printing bullish candles continuously since November, really, along with equity markets, and it's all to do with the expectations of demand returning with the major economies reopening and so on. And the OPEC surprised the markets last week when it decided to roll over the output cuts into April. And the price of oil hit a new high for the year. Momentarily, it rose above the psychologically important $70 a barrel. And I think that was in response to the weekend news that there was a drone strike in one of Saudi's oil refineries or something. But after price had gapped high overnight, it fell back down. However, as you can see, it's bounced off the support level at 67.68, suggesting that the buyers remain in control of price. So I wouldn't be surprised if oil were to make a new high for the year. Like anything else.
Yeah, that's if we look at the monthly chart, my favorite long-term charts, Fawad. I keep bothering you with those.
No worries.
We had
Oh yes, massive
a
level.
visit to a very strong level, and we might see some retracement from here. I cannot rule it out, not
Yeah.
at this point in time, with such a relentless rally all the way from 35 to 70. I mean, it's
Yeah. It's
basically a
during a
doubling.
pandemic as well, right? I mean, if it happened at any other time of the in normal circumstances, then you'd be like, okay, fair enough. But it happened during a time where the most of the global economies are still in lockdowns, right? So
Yeah,
that's what it's kind of worrying me as well. But yeah, sorry, go on.
yeah. There's been a lot of stocking up from China, from other Asian economies that have been taking advantage of relatively low oil prices, and this might these bounces in demand might be over now. Like, there is no incentive for these countries to continue stocking at current prices. They were very much attracted by lower prices before, but at this point in time, I don't see this holding for a lot further. I mean,
I agree with your view. And also, if you think about shale producers, you know, rising oil prices will encourage them.
Producers are coming back at these levels, are starting to come back at least. So we should see production pick up and offset any rise in demand that stems from the end of lockdowns and so on.
And remember as well that OPEC related production cuts will be eased in the months ahead slowly. So more oil is going to come from OPEC as well as non-OPEC producing countries, which means supply of oil is going to increase once again. And if demand is not going to be sufficiently strong to offset those increases, then price of oil has to fall to make new equilibriums at lower levels.
And last but not least, on Friday, Goldman Sachs upgraded their oil price target to $80, which usually means that you should
that the top is in.
Do the opposite.
So there you go. You've had your warnings, guys. Don't, you know, if oil prices fall from here, don't say we didn't tell you.
And never trust Goldman Sachs.
Obviously, in the short term,
that was a joke. Obviously, compliance don't kill me.
Yeah, we need to balance out our overly optimistic and pessimistic views in these webinars because of compliance reasons. So, yeah, we do have strong bearish views on oil at these levels, but it's important to note that markets can remain irrational longer than you can remain solvent, as someone famous once famously said. So with that in mind, oil prices can overshoot to the upside because of ongoing momentum. But that's not to say that the long-term outlook is bullish. The very long-term outlook on oil is really bearish, if anything, because of the drive towards renewable energy, electric cars, and so on. But that's a topic we will discuss another day. But insofar as today's session is concerned, guys, time has run out, and we can't see any questions, which means we can end the webinar. So thank you so much for joining us. Please do make sure to join us next week at the same time. So for those of you who are watching this on YouTube, let me show you how to register. So you go to our website, you go to market analysis. There's a section called live webinars. Click on that. And here you will see the upcoming webinars with myself, Fawad Razaqzada, and my colleague who is on this webinar, Victor. And we have a list of upcoming webinars. This page hasn't been updated, but we are going to update it as soon as this webinar finishes. And you can literally register for those webinars by clicking on the button and put in your details, click on register, and then you'll get an email with all the login information. So it's as simple as that, really. Make sure to join us next time so we can talk live to you guys about any markets that you are interested in. But insofar as today's webinar is concerned, thank you so much for joining us. I wish you all the best and see you next time.
See you. Good luck.